Welcome back to another episode of What's on Your Mind. Joining me on the call today, I've got Raj Malhotra and Anthony Iser. Gents, great to have you both back on the show. You've both had some great stock picks in recent episodes of What's on Your Mind. A couple that stick out for you, Raj, are Long Teladoc and DocuSign, both performing really well. I think up around 15 to 20% since you mentioned those. And Anthony, on the last episode of What's on Your Mind that you did, you mentioned a pair of Zendesk versus Live Nation, which is also doing really well. I think up around 20% as well. So I'm really looking forward to what's in store for this episode from you guys. And with that being said, Anthony, why don't we start with you? What's been on your mind?
Hi, Chris. Hi, Raj. Thank you. I'll have another pair trade to discuss a little bit later on. But looking at all these markets and what's going on, I was just thinking if we had been doing one of these 12 months ago, the three of us having a chat, and they said, okay, well, in 12 months' time, unemployment's going to be up somewhere between 15 and 20%. Fed funds rate will have dropped from 2.5 to 0. PMI has gone from 52 to 37. Gold's ripped 32%. Stock volatility's tripled and up near 70. And oil down 70% and traded negative. And at the same time, I said stocks would be flat. I just wonder if anyone would believe me with that. So we're in a really interesting situation at the moment where fundamentals are very hard to come by. You've got the massive tailwind of the Fed and the huge unknown that it's pushing against, which is this virus, and more importantly, the economic impact from the measures that are taking place. I'm sitting here in Melbourne. We've been 3 weeks with a couple more to go, I think, of near total shutdown, outside to exercise, get food, go to the doctor, and if you happen to work, you can do that as well. But that's essentially it. So the whole place has come to a standstill. Local travel, international travel, everything you can think of. So the economic impacts are going to be real and the behavioural impacts are going to be real. It's just a question of sort of what the other side looks like. We've seen plenty of news of the US, Raj. How are you finding things over there?
Well, I find it somewhat ridiculous the way it's been handled. I understand the first thing was as there's uncertainty, we shut everything down. But now that all the data is in, that it's not nearly as bad. The fact that we're so slow to roll things out is utterly ridiculous. I think and I think what's important to look at it is because of the hysteria being created by the media and the people in power, that they want essentially for with a power shift that they don't want to. They created this hysteria. So you have to look at, on the other side, when the world becomes quote unquote normal, when you hear ridiculous statements like we should never shake hands again, that's not normal, but that may indeed be the normal. So when you're looking at companies and the economy and industries there will be ones that will benefit and not benefit from this quote unquote normal. That's the companies I've been looking at. Like, for example, if you look at 9/11, air travel was changed forever. If you look at 2008, the financial crisis, leverage was out of the system for the most part for a while. So these, even if we did have a vaccine tomorrow, there would still be changes in the way people perceive social interaction and basic defenses against the next virus that may come, and that's how. And since it's always in people's minds now, they've been ingrained in them, it's hard to untake that out. So I think that's how I've been looking at it as a whole. And that's how I've been trying to look for opportunities in this market.
It seems that way that the market is going to split into those companies that sort of push on through and the economic activity broadly reverts to what it was, and where those behavioural and economic changes are more permanent. Because like you said, people get it in their head. It's a process at an individual level, but also at a company level. Companies can find out, hang on, I can do less with more here. And so, they then go and operate in that way as well.
Yeah, I wouldn't be shocked to see, since now most workers have been shown that they can work at home in most industries for the most part. And once that infrastructure has been set up now, to get people to go back into work, perhaps that'll lead to less big office space needed, meaning like less employees need to work there or in some kind of rotation, which is the way it's been. Because if you look at really the corporate world, most of it's been uninterrupted. Obviously revenues have gone down, but in terms of the for example, like financial services, do we really need everybody? Do we need thousands and thousands of people in Morgan Stanley's office? The answer is absolutely not. Or do you need if a CEO is working at home, does his assistant need to be there? No, there's plenty of there's plenty of jobs that permanently can just be changed, and that'll have long-reaching implications into real estate, and also into pay. I wouldn't be shocked to see more people's incomes go down with the trade-off of them not having to go into an office.
Yeah, okay, that makes sense. So is there anything that you have looked at that looks sort of quite positive coming through this period?
Yeah. Actually, there's a company that I've had my eye on for a while, and I think this is the real impetus for this company. It's a company called EverBridge. The ticker's EBBG. The market cap's about $4 billion here. So what the company does is they basically sell communication services for emergencies. Like they call it CEM, which is Critical Event Management. It was first used in Hurricane Sandy. It's been used in the Boston Marathon bombing. It was originally for emergencies and like school shootings and basically anything we needed to warn the public very quickly in terms of some kind of event in real time. So it's pretty obvious what the catalyst here is. It's going to be the public will demand this for not only companies, municipalities, states, given COVID, and as we go on the other side, it would be almost impossible for governments to not say that we need some kind of emergency system to tell our citizens. They've actually won contracts in Australia and Singapore already. They've won 4 recently in Europe with Greece, Iceland, the Netherlands, and Sweden. I'm sure the EU will just basically demand this for all their citizens because they want to be totalitarian. So, but in terms of they can, all these governments can hide behind this because we're keeping the public safe. And then that liberal big cities like New York, Los Angeles, Las Vegas, Boston, all these cities will have a natural market for this product, and they've had some proof of concept. So I wouldn't be shocked if revenues in the next couple of years they could easily double or triple. So looking through the fundamentals of the company or the numbers of the company, they report May 5th. I mean, the earnings, and they don't make money, so the earnings don't really matter too much in this name right here. More importantly, this is a revenue story. If you look at last year's revenue, if you look at last quarter's revenue, they reported 58 million, which is 35% year over year. On all of 2019, their revenues are 200 million. They're expected to make something around 260 million this year. Any uptick in that, you could see a very big increase because again, there's going to be a lot of suitors for this name should it be taken out, whether it's Amazon Web Services, Oracle, Salesforce, Microsoft, SAP, you name it, with a $4 billion market cap, like I said. But with the revenues of 200 million, this sector on acquisition generally trades from 15 to 20 times revenues. So that would get us to a valuation on the high end of 4 billion. But having said that, this is like if you fast forward a year, it'd be hard for me to see a scenario where the revenues just don't go up in this sector as a whole. I mean, they could easily double, and this company stands to be a big benefit of that. So in terms of how I want to play this, I think that it makes sense in options, especially given the valuation is kind of rich. You could, if the story subsides and my thesis is wrong, I'd like to limit my downside. But I also think that there could be tremendous upside here. So what the structure I like here is I'd like to sell the May 130 calls for $3. I just don't think that there's really going to be a story yet. It's just going to be a longer term story where they can sell hope. But right now, as municipalities and governments aren't spending the money yet, it'll just be they don't have any money yet, or they haven't gotten around to that. They're still dealing with the current crisis. I guess that would mean that they'd actually have to come to work, because as we know in the U.S. Congress, they haven't been in session since May. Since March, they decided to go home because I guess they're not critical. But anyway, if you sell the May 130 calls for $3, looking out to August, I could buy the August 120 calls for $15. So for a net debit of $12, I think once they come back in the session, and as this thing burns out or subsides, that's the first thing that they're going to signal to the market. It's like, okay, how are we going to prepare our citizens for the next thing? And this will be in almost any stimulus bill, whether it's the U.S., the EU, Australia, whatever. So that's the way I would like to structure that trade. And could it be a $200 stock in a year? Sure, why not?
That's really interesting, Raj. I think software in general as an industry could be something that makes sense, right, going forward. Perhaps the caveat being that a lot of people are seeing high valuations there, but nonetheless. Anthony, what about on your side? What have you been looking at?
Well, I think you're spot on, Chris, and I like Raj's idea a lot there for finding companies that are specifically going to sort of do well out of this disaster. Company I'm looking at is a software company. It's been around for a long time. Everyone knows it and has used its products at some point, and it's Adobe. And it's performed very well over the last few years, like most of these big SaaS style companies. $130 odd in 2017 to 333 or so now. Had obviously the dip that everyone had last month, maybe down to 250 or so. EPS has gone from 338 to a forecast of 979 in the coming year. And they've got quality management. It's a quality company. It's a big company, $160 odd billion. But they're one of the few legacy softwares that really made a successful transition to the cloud and SaaS model. And they were early adopters and movers into the cloud space. And as a result, they've had 5 years in a row of quarter-on-quarter growth of more than 20%. These guys had mid-March numbers come out and they beat expectations. And unlike most of the market, they were happy to talk about future expectations. Obviously with some caveats, but their SaaS business and their enterprise business is quality with recurring revenues that clearly can come down if people want to drop them. But what we're looking for is these longer term contracts and relationships and ongoing fees, and that makes up about 75% of their business. There is some risk in what they call their digital experience business. It's part of the business that we know a lot of as individuals. So it's less the analytics and the commerce part, but the content and the advertising could come under pressure in the next quarter or two. But all in all, this is a company that has no debt. Similar situation to what Raj mentioned. If it was to come back in any sort of size or way, there would be suitors out there. Salesforce, Microsoft have balance sheets big enough to take this on and would sort of fit well within those companies. So it is quality. It trades at a premium to the peers in the big name software sector. And at this point in time, yep, fine. The market might come back a little bit. It could come back. But I think it's going to outperform. And that's why I would pair it up with another trade. Or you could look at a calendar spread like Raj has talked about But at this point in time, I'd be just sort of long outright and finding a sector that's not going to do very well and a stock that's not going to do very well to put on the other side.
Let's talk about that then. We may as well stay with you, Anthony, and keep on topic of what you were just talking about. What sectors are you looking at, or individual stocks for the other side?
Yeah, well, there's a sector that's, I think, going to do incredibly poorly, and that's the US auto sector. And you've got a huge range of options in this sector. GM's come out and said they're no dividends, no buybacks, conserving cash. They're in dire concerns about new car sales. And this is a big market, $1.3 trillion market. And the key thing for me is 40% of it is below prime in terms of the lending. So if you think back to 2008, the subprime lending was a real problem and kicked off massive financial distress. I think the same thing could happen in the auto market. 40% of it is subprime. Even before this, things were starting to look bad. So just to give you an idea for the sector, December last year, obviously unemployment below 4%, very strong period, as good as it's been in decades, sort of with 8, 9, 10 years of economic growth from sort of the lows of 2009. Despite that, we were at 8-year high in delinquencies in auto loans. 2.5% of people hadn't had more than 30 days in arrears, which is pretty negative for when a period when economics should be suggesting that should be very good. At the same time, the rejection rate went from 4% to 8% from a year earlier. So more and more people putting in suspect loans, the terms not looking good enough for lenders. And then obviously we've had this virus hit, sales down, let's call it 30% across the board. So there's a lot of different ways you could play it. The company I am looking to be short on the other side of my Adobe long is SaaSy. Now they have been a very strong company for quite a while. Share price has performed well. Their earnings growth has been 20% on average for more than a decade. As a quality financer with a quality business model. In fact, earnings growth, even in these last 2 or 3 years, 22%, 18% coming into this year. And I think over the last decade, probably averaged closer to 25%. So very, very solid performance. Now, 42% of that has come from a reduction in share count, so through share buybacks. That's a perfectly legitimate thing to do, but suggests obviously that there's competition or less opportunities to grow and trying to support earnings via buybacks. That's all good and well, but when that dries up, that's also just another level of support that comes out of the company. They had announcements recently where they discussed competition. The CEO described competition as being very, very competitive for 8 to 10 years now. So the market is tough. Volumes for this company are down 25% over the last 18 months. They've lowered the standard for their dealer enrollments. So all the car yards and dealerships that they deal with, they lowered the standards that allowed them to deal with CACC. And what resulted, you would expect that they would have more dealers come on board. Actually, the number of dealers declined despite that. The number of units that they do per dealer has gone from 44 to 27. Their recoveries, so how much of each dollar of loan that they get back. There's some complexities to this. Their business model means that the dealers take the first hit, but that's gone from 72 to 64%. So quite a sizable reduction in their ability to get a return. They have also moved from their business model, which was this tiered structure that allowed them to take less credit risk and their dealers to take more credit risk. A third of their business is now traditional auto financing. The CEO founder has been selling stock like crazy for the last month or so, and short interest in this one has kicked up a bit, 22% now. So do need to be cautious of a short squeeze, but I think the market's on the right track here, because the real kicker for this one was they didn't release their first quarter results. They haven't released their full results from last year, and they won't be doing it until until June 25th at the earliest. When a company defers results, it's always a concern. And so you would understand companies at the moment saying, look, our business is really hard to gauge. We don't know what's happening in the second quarter. We're suspending guidance. You'll have seen most companies out there have done that type of thing. It's just too hard to determine. However, they're talking about first quarter here, where for the first and second months, there was virtually no impact from COVID-19. March had some impact, but they still have no ability to get numbers out. And that's a real concern to me. And I'll spare you the sort of 20 or 30 point announcement of some of the risks that they see, but I'll give you just a couple of highlights. Our inability to accurately forecast and estimate the amount and timing of future collections could have a material adverse on our operations. We may be unable to execute our business strategy due to current economic conditions. We may be unable to continue to access or renew funding sources or obtain capital to grow or to maintain our business. The terms of our debt limit, how we conduct our business, limit how we conduct our business. And violations of terms of asset-backed securities could have material impacts on operations. It's a big, long list. It's a massive disclaimer, and they're saying we can't put numbers out because our business is in such dire straits that it's all hands on deck working out how we survive. Now, I'm sure they will survive, but when you've got a sector that's got such a terrible outlook, 24 million people unemployed, loan defaults are going to be ramping up in a big, big way. I think this is a sector that's going to be under trouble, and the ticker SaaSy is one that I'm going to be having a good hard look at, because I think it makes potentially a very good short on the other side of the Adobe trade.
Yeah. Okay. Yeah. That sounds pretty compelling. Raj, what about with you? Have you looked at any shorts for the other side of your long?
Yeah, actually, it's funny. Me and Anthony are different sides of the world, but we're looking at the same crappy sector. So, actually, this short idea came out. One of the short ideas I'm going to present now actually came out of our Thailand mentoring program, which just finished, which was actually done over Zoom. So it actually worked out quite well. So that's why I look like I have such a suntan. But anyway, the idea I have here is in the sector, so I don't want to give you the same details Anthony had, but obviously you know that the sector, in my opinion, was weak before COVID, and clearly now I don't see on the other side how auto sales are the first thing that people are going to spend money on, given that nobody actually wants to travel or with economic uncertainty. So the company I'm looking at is Carvana, CVNA. It's actually a pretty interesting business model. If it has never happened, this is a disruptor in this industry, and in a growing industry, a disruptor has tremendous upside, and that's why it's been trading at levels where it has. But given how my view of going forward in the auto industry, they say the bigger they are, the harder they fall. It was an e-commerce gimmick. Is a gimmick, but where basically you buy these cars through car vending machines, locations around America. You can complete all the paperwork in 10 minutes, and the car gets delivered to you the next day. All this stuff seems pretty cool, and but the problem with this business model right here is all of it was driven by car sales. And if you look at what happened was Carvana, believe it or not, was actually able to raise money in this economic downturn. They actually were able to get $760 million of short-term debt, and they were also able to raise 600 million outside of that, and the stock actually had a big run up from lows of around $30 to up about $90 when their financial partner, Ali Financial, basically said that they would extend credit to them of short-term finance up to 90 days for $2 billion. So the market, and given that this is probably a big hedge fund short and a lot of short interest, if you look at it, it had a big rally and took all the shorts, out. So having said that, on the other side of that, as the short coverings kind of subsided, let's look at the fundamentals of the company. They're not going to make money, which is that's actually fine here. The consensus this quarter was to lose 58 cents a share. It's probably going to lose 68 cents a share. But really, that's not the issue here. The big issue is if you look at their revenues. They've had such an explosive revenue growth story. From 2000, in Q4 last year, they had 82% year-over-year growth from Q4 the previous year. And in 2019, that 100% plus revenue increase over 2018. And the market loves those kind of growth stories, even in lieu of earnings. But now, when you look on the other side, what are the chances that they're going to get another 100% growth in 2020? Probably pretty low. And if you look at the revenues, they're expecting this year around a little over 1.1 billion, and with a market cap of 14 billion, in an industry that's quite honestly not that exciting. It's not like we're talking about 14 or 15 times growth in the software industry, which is an acquisition candidate, and there's core competencies with other businesses. This one is just cars, and cars are if you look at the price of oil, they're going by the way of dinosaur. So, just for comparison, not that they're the same company, but if you look at like GM, they've got a $32 billion market cap and $137 billion of revenues. Ford has $21 billion of market cap and $155 billion of revenues. Carvana has $1 billion revenues, 1/20th of Ford's revenues, but only 1/10 of their market cap. Not to compare apples to oranges, but clearly, the lofty valuations of Carvana could cut this stock in half as a base case within the next 6 to 12 months. So the structure I've been looking at is to take advantage of short-term volatility and earnings. And actually, if you notice, it's been a pretty common theme in what I've been saying. And the things I've been pitching is because if you think about it in Q2, whatever companies show now for earnings, the market's already discounting. The market doesn't really care about what they made in the previous quarter because everyone expects it to be awful. And it's somewhat irrelevant because it's not a quote unquote normal quarter. The market's not going to look at this quarter and say, this is what quarters are going to look like going forward, 6 months from now, because this was in many ways a one-time event. But anyway, so the structure I like is I like selling this May 75 puts for $5.50. Looking at the August, I like the August 80 puts. I can pay $16. Essentially, I can pay $10.50 for this spread, even in a scenario where the market tanks in the next 2 or 3 weeks in this name, I'll at least break even, if not make a slight profit. If Carvana stays above $75 by May expiration, I've added a tremendous amount of alpha to my portfolio, and essentially I'm only paying $10.50 for the 80 puts. If the stock goes down to $40, I can make about a 3-to-1 payoff. So I really like this trade. Granted, option prices are high here, but they're high for a reason. And this is a name that really could really get beat up long term. But having said that, given that the amount of short interest is in this name, you don't want to just be outright short this because, like you saw, the short squeeze from 30 to 90, stock could go up again just because of positioning. And remember, positioning in this market is almost as important, if not more important, than fundamentals. So just keep that in mind when you want to be outright short or outright long names that have a tremendous amount of speculative interest.
Yeah, that's really interesting, gents. It's been a great episode. I think we'll finish off there. I think it's a good example, this episode, of how important it is for traders to be forward thinking. You guys have both talked about a new normal and both come up with very similar themes in how to address that potential new normal to gain some profit out of it. So thank you guys for coming on the show. I'm sure our viewers will appreciate your thoughts. As for all of you guys watching and listening, a couple of things that I want to point out in terms of Institute events coming up. We've got the implementation conference on this Saturday on the 2nd of May. So by the time this video goes out, you may or may not be able to get hold of tickets. I'm not sure, but if you can, I do suggest you do so as soon as possible. We've also got our emergency room program running, our second one, because of the success of the first one. We got really great feedback. That's running from the 4th of May, so Monday next week, through to the 15th, so 2 weeks starting Monday. Anton Creel's hosting that with all of our mentors, so Raj and Anthony here are both involved at various stages. And like I said, we got great feedback for that, so I'm sure all of you will be really interested in signing up. And finally, a webinar that we've got going on the 9th of May, I wanted to mention, which is called Self-Determination in a Crisis, which is very apt for the last couple of months that we've been through in markets. That's hosted by Anton Creel and Jason McDonald, so that'll be really great as well. As always, you can find out more information about all of that on our website, i2pm.com, and I'll put some information below the video for you guys as well. But that's it for another episode of What's on Your Mind. Make sure you join us next time for another great show.